Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In the latest episode of the podcast, I took the chance while down at an interesting conference at Hay-on-Wye over the weekend to try and get some perspective on what's going on effectively with the Trump administration's hyperactive policy program, and also to try and measure the risks associated with many of those developments. It's an unsettling time for investors, with consumer sentiment and industry sentiment having been knocked back by the setbacks that we've seen in markets so far this year. To discuss those, I sat down with Russell Napier, who is a seasoned market strategist, who also is the founder of the so-called Library of Mistakes in Edinburgh, a charitable institution which aims to provide materials that investors can learn from when it comes to historical experience. And also Edward Chancellor, the author and journalist, whose most recent book, The Price of Time, is an authoritative study of interest rate movements and interest rate policy and interest rate theories over the last century or so. It seemed therefore a very good idea to sit down with them and get their perspective on what's happening. And we started off by asking whether there were any historical comparisons that would help us understand the scope of what is going on at the moment, unsettling as it undoubtedly has been. So, Russell, I'm going to start with you. We've had this blizzard of activity by Donald Trump as he's come into power. Perhaps you could just quickly pick out some of the highlights of that, and then we'll go on to the question of whether there's any coherence or indeed logic in what he's doing.
Well, 93 executive orders already. The total Biden production was about 160, so he's off to a fine start. The executive orders are diverse, and they involve removing security details from people he doesn't like, the reintroduction of plastic straws, the abolition of the penny. But of course, lots of more substantive issues, and the substantive issue that makes the headlines are tariffs. And the question is this tariff strategy part of a bigger deal, a central theme that will run through the Trump administration trying to achieve something? And that's what we're all kind of hoping, because it looks erratic, it looks volatile, it looks unpredictable. We're all trying to look through the blizzard of executive orders to find that path.
To find the path beyond, indeed. Well, some of the headlines include your tariffs. We've had talk of deregulation. That's happening. He's talked about cutting taxes in due course. So, Ed, moving to you, historical parallels for this? I mean, in terms of the range and the intensity, perhaps, or indeed possibly the lack of reason behind some of these activities.
I find a historical parallel in a place that will seem quite strange to most people, in that what Donald Trump has done to date looks to me in some ways quite similar to what FDR, Franklin Delano Roosevelt, was doing in the 1930s with his New Deal. One of Roosevelt's earlier collaborators in the New Deal, who parted ways with him, later described the New Deal as a hodgepodge of conflicting policies, sometimes in favor of cartels, industry cartels, other times applying antitrust policies. But the consistent theme that I take away from my reading of the New Deal, which is conventional now, is that Roosevelt's policies were undermining business confidence. And what we saw in early March was this index of business confidence that economists have created, rising to its highest levels since Roosevelt in the 1930s. And that collapse in business confidence, research suggests, discourages investment. Of course, how are you going to invest if you're in the 1930s, if Roosevelt's changing his tax policies, he's attacking you as an economic royalist, you're not going to invest a great deal. And likewise with these tariffs all over the place, it's a massive disincentive to invest.
Absolutely. So the immediate kind of reaction I think you hear from a lot of people around the markets is, well, this is going to lead to slower growth and higher than expected inflation. Is that the right diagnosis, Russell?
Yep, I think that is the diagnosis, at least for the next 12 months, while we try to work out if something better or greater can come out of this. The implication for people who invest, of course, goes beyond merely what this means for the economy. And the uncertainty which Edward outlines, which I completely agree with, has an effect on domestic behaviour, domestic investment, probably even domestic consumption. But it's going to have a particularly big impact on foreign investment and the flows of capital. And in that shorter time horizon, that 12-month time horizon, what we're really interested in is liquid capital flows, portfolio flows. And I think a lot of the analysis of what Trump is doing, if we go through those executive orders, he's not really saying much about that. And if you listen to his advisors, they're not really saying much about that. And you're trying to ignore it. So I just one little snippet, which I think hopefully puts into context what could come next. It's a speech by Emmanuel Macron on the 26th of April last year at the Sorbonne called Europe It Can't Die. And in that he says it is absurd that Europeans invest 300 billion euros a year in America. Well, that was before their election of Trump. And the foreigners own $61.5 trillion worth of American assets. So this uncertainty that it would absolutely, after he points out, can affect domestic behaviour. There is now a prospect, I think, that foreigners will begin to withdraw money. We are at the weekend of mistakes here in Hay-on-Wye. It was really fascinating that one of the questions earlier today from Gentlemen Who Invest in America is, did we think that he would be allowed to keep title to those by the American administration? Well, the fact that that question's being raised, I've never heard it raised in my 35-year career. The fact that that's even being raised might tell you something about the willingness of foreigners to hold US assets. And it might turn out in that time frame that is one of the most important facts that has just been unleashed by Trump. I don't think you can unleash it. Once you put yourself forward as an untrustworthy partner, I don't know how you come back 2 weeks later and say, just kidding, I'm actually very trustworthy.
Right. So let me ask you this question bluntly then, and I'll start with you, Ed. Is the interpretation of that he doesn't actually know what he's doing? He's a real estate man. He thinks about territory, not about sovereignty. He thinks a lot about debt and wants to get interest rates down and so on. Without going into kind of detailed psychoanalysis, I mean, is that a possibility that this guy really doesn't appreciate what he's doing? Or has he actually got some agenda which has some kernels of sense in them?
Well, I think one has to be careful about falling into Trump derangement syndrome. Trump derangement syndrome is really suggesting a person is a complete moron and beyond pale. First of all, you have to bear in mind Trump has been president already for a 4-year period. And he has an agenda, whether one agrees with it or not, as Russell points out, by making all these executive orders in such a short period of time. It's certainly not an economic agenda that conventional economists agree with. And I'm talking about economists from the libertarian sway through to the socialist economists. There is almost a unison of voices critical. Again, it's quite similar to FDR, where FDR had pretty cranky policies that were criticized by likes of Schumpeter and Keynes. Is there a core idea? Yeah, there is a core idea. The core idea is to bring manufacturing and industry back to the United States, for the United States to operate as a sort of autarkic economic system, and for the blue-collar Trump supporter to benefit. And Trump probably owes his political success to the fact that millions of US manufacturing workers lost their jobs to China and globalization in the first decade of this century. And he's trying to reverse that. The question is whether he's going about it in the right way. And I think in the first Trump administration, when they put tariffs on China and encouraged the change in global supply chains to what was called friend-shoring, of having your manufacturing, having smaller supply chains with friendly countries, that sort of made sense to my mind. But then what Trump's done is shown more interest in attacking the near supply chains in Mexico and in Canada, really, than in what's going on in China. I find that very hard to understand.
I think it's a really quick question on the real estate, because I think in the real estate, it's mano a mano, it's a negotiation. There's not many unintended consequences outside of the real estate deal. And if you live in that world, that's the world you get into, and that looks to Slaggy, that's what he believes is happening. But clearly that's not the world that we live in. That's not Trump derangement syndrome. It's simply to say that he hasn't really thought through, or didn't want us to think through, the unintended consequences. The nearest thing it seems to be to a manifesto for this is a thing called the Mar-a-Lago Accord. And when you look at it, there's a lot of assumptions in there about the stability of capital, that we do X, Y, and Z, but capital doesn't move over here. So whether that's wishful thinking or not understanding or choosing not to understand, I do think there's quite a lot of that going on in the Trump agenda. And therefore, what the rest of the term will be about is coping with the other things that have now moved, which in the real estate world weren't ever going to move, but now they have. Other pieces have moved on the board. I expect responding to those is quite a big part of his agenda.
If that is the correct analysis, where do you think those fault lines, if you like, will show up first? Will it be in the dollar? Will it be in the bond market? We've already seen a big sell-off in the equity market. How do you think that might play out, if I can put you into that?
Bernie, he's quite keen on the dollar coming down, so he's not going to be concerned about that one. People used to think he was concerned about the stock market coming down, but we know Scott Bessent has talked that down. Maybe he is, maybe he isn't. But the one that he can do, though, is the bond market. Now, since his inauguration, bond yields have come down. This is kind of a meaningless thing because, they went up ahead of his inauguration. But the thing that would really focus the mind of Trump, really discipline him or force him to discipline the markets, would be a rise in bond yields. Foreigners own 1/3 of the US Treasury bucket. That's divided equally between half of that is owned by foreign reserve managers, half of it is owned by the foreign private sector. But let's take a practical example. Let's say the Germans put out an edict that all of the new German bond issue has to be funded by the sale of treasuries. I'm not suggesting that's going to happen, but imagine if it did happen. The end consequences for German bond yields, consequences for Donald Trump, and how Mr. Trump might react to that. So that the point of all this is basically his trade wars will become a capital war. And in that capital war, I think we are likely to see US bond yields go up because he's forcing the Europeans to issue huge amounts of debt to fund their own independence without recognizing that there might be a catch-22 in there because the Europeans are very large owners of US assets.
Indeed, that has been a trend. But what do you think, Ed? You mentioned Scott Bessent. He's someone who's worked in investment, hedge fund manager, and worked for George Soros, among others, back in the day. He's the Treasury Secretary. But does history give us any comfort, perhaps, that having grown up in the room at the Treasury is actually going to rein in some of the more extravagant proposals that Trump is pursuing?
I don't know. I know Scott Bessent a bit and like him. And from my meetings with him, I would trust his judgment. He doesn't say foolish things. He's a thoughtful, intelligent person. He also understands that the US financial system got into a pretty dysfunctional and dangerous place with this period of ultra-low interest rates. This is what I had conversations with him about 10 years ago, more recently. And so when he says the other day that the US needs a detox, we know what he's talking about. A detox meaning a movement, I'm taking it anyhow, a movement away from this highly financialized system where companies are bought and split up and leverage the hell out, and management is directed at extracting capital from share buybacks rather than investment. He also knows, because every investor knows that the US stock market is extremely highly valued relative to its historic valuation. It was trading on a cyclically adjusted price-earnings ratio of 38 times earlier this year. And that's in the top 1 percentile of valuations, or if you want to have it in terms of sort of standard deviations, that's 3 standard deviations from the mean. And those events are very rare, that type of extreme valuation. So if you add a lot of uncertainty to a market that is trading, a stock market, not bonds like Russell, at very high valuations, you are likely to get volatility and a sharp stock market decline, not the correction we've seen today, something much, much greater than that. And I would go back to Roosevelt. When he scared the pants off American business in 36, 37, the economy contracted, business investment collapsed, and stock market went down, I think 34%, from a valuation that was high, but not as high as it is today, or at least it was a few weeks ago. Valuation a few weeks ago was at the highest level, except 2 points in history, early 2022 and early 2000 at the peak of the dot-com bubble. So Bessent will know this and will be wary of it. And my guess is that given that American wealth, and not just stock market wealth, but the collective wealth, is so elevated relative to the GDP, to the national income of the country, that the Americans however much they might feel they need a detox, if that detox comes about through a collapse of their wealth, that will change the political mood. We haven't yet heard anything from Congress, have we? So the moment the elected politicians, the lawmakers take their seats, then they will sooner or later have something to say. And then again, I think the situation Roosevelt is constructed, because after 37, Roosevelt lost control of Congress. And that brought the New Deal to an end. I know a lot of what's going on at the moment is going on through these executive orders, but there's a limit to the executive orders. Sooner or later, you need Congress to start making laws. And if you upset the apple cart, Congress is not going to do your bidding.
I think also the Supreme Court ruled against some of Roosevelt's legislation as well. So there is a chance that many of these executive orders are deemed to be illegal.
Yeah, we'll see about that.
Yeah, so there are checks and balances in which we haven't yet seen them come through yet.
All we can say is there are legally checks and balances. They have worked historically.
Will they work this time?
Will they work this time?
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So given the kind of style and ambition of Trump, obviously, and the kind of wrecking ball he's happy to bring to certain areas, from what you were saying earlier, do you think there is a risk of us moving back into a world where we have either capital controls or we lose independent central banks?
So that's been a long-term forecast of mine, but it's not really related to Donald Trump. He may be a political manifestation of a deeper problem. The deeper problem is, Edward alluded to it, which is financialization, which is too much debt. So across the developed world, debt to GDP is very high. America is very high, but not the worst. In Japan, famously, is much worse. Actually, France is very bad. And the Thai government is very bad. So if you live in a very high debt to GDP ratio, the most likely politically acceptable outcome is a way of inflating that away. And it seems to be, back to your two questions, very difficult to have an independent central bank if you want to inflate away your debts. And also somewhat difficult to have the free movement of capital as well, because you're the guy who's being slightly more aggressive in inflating away than others. You might see an exodus of capital. Corralling savings into fixed interest securities with unattractive real yields is at the core of inflating away debt. And corralling capital means restrictions on its free movement in some form, cross-border or otherwise. So yeah, I think the monetary system that we will develop is very unlikely that it has independent central banking as we have known it. And it is likely that it has some, at least, speed bumps for the free movement of capital.
So, Ed, in this country, in the UK, to state that, I mean, we had independent central banks, which is a movement that started about 30 years ago. But I'm old enough to remember when we had capital controls in this country. I think we all are. What are your thoughts on that? Do you think this is a return to base, so to speak? Return to not go, I should say, perhaps?
So I was thinking the other day that a synonym for independent is unaccountable. And the central bank is just one of a myriad of institutions, or quangos, call it what you will, that politicians have put the decision-making power to in order not to be held responsible. And I think that my view is the Bank of England has failed as an independent institution since 1997, when Gordon Brown gave it its independence. It's failed on two fronts. One is that, along with a lot of others, they lost control of inflation in the last few years. I think another really important issue is that they lost control of their balance sheets. So Bank of England, through its quantitative easing, has lost tens of billions of pounds and sends bills to the Treasury, taxpayer. And I think that really is a disaster. We were talking about Bank of England earlier today, and the point about Bank of England in its heyday, in its early days, is it looked after its balance sheet. And the point about Bank of England since independence is it's blown its balance sheet to pieces. And actually, what blowing its balance sheet to pieces, by bringing interest rates down so much, it actually encouraged incredible government profligacy. So I think that's been disastrous. And I think that it would have been better had a politician had to take ultimate responsibility for those decisions.
I think there's a nice marker for this. So Paul Tucker, who's the former deputy governor of the Bank of England, has written a book called Unelected Power, in which he refers to these institutions, and Edward points out is more than the central bank, has overmighty citizens. And then raises this question, how does the society deal with overmighty citizens? I think that a deputy governor even raises such questions, even if he doesn't give his answers, is saying that society is asking these questions now, and the pendulum is beginning to swing.
It's almost like the separation of church and state in the Middle Ages, that you had the church, the Archbishop of Canterbury, Thomas Becket, and
I
recalcitrant.
don't think you should go too far. What happens to Thomas Becket? You can finally start there.
Okay. But anyhow, it's a similar type thing. You have a monetary power that is set up independently. And when you add a gold standard, that in a way becomes, at least initially, uncontroversial, because there is a standard and the central bank is just ensuring the convertibility of the banknotes into gold. But now these are questions of judgment in a fiat currency.
So I put this another way. All we're saying is all monetary systems fail. It's just a matter of how they fail.
Yeah.
I think the question you're raising, we have believed this as being inflation targeting, with independent central bank and inflation targeting, reporting that we had both of them at the same time. Are people questioning whether it's failed? Yes, they are, and not just sitting in this lovely room in Hay-on-Wye. I think policymakers are questioning that. So whether they do it through changing the target or actually sort of taking over the central bank, it's coming yet for all that, and all that, it's coming yet for all that, as Robert Burns said. It seems to be one of those inevitable turning points in history. And it's common, if you're a financial historian, you just say, well, this happens a lot.
We've seen it before.
It takes 30, 40 years, but it comes, and it's coming.
But Russell, the only caveat I add is that although the Federal Reserve is putatively independent, as we all know, it has always been subject to a lot of political influence. You were talking earlier today about Arthur Burns, but you can go right back through the Fed's history. And so no central bank is going to be completely independent.
No, in practice, of course not. So, Russell, I asked you this question. I mean, you've written famously a book about bear markets and how they arrive, when they end, and so on. Is it something that we should be expecting now from here?
The reason I looked at four-bit bottoms, the reason I defined them, is that the 6-day adjusted P was below 10. And as Edward has just pointed out, it's now 38. So it may be premature to be talking about great bear market bottoms. I mean, I should stress that the book just focuses on great buying opportunities. There'll be lots of trading opportunities in between. But you certainly can't read that book today and say the fundamental precept here, these things are so cheap they have to be a buy. We're not there. And if you look across the world at other developed world markets, they're a lot cheaper than America, but maybe not that cheap. What I would then do is maybe separate out value stocks, which may be the last refuge of the scoundrel for many of your people listening to this. Then you do find actually that some valuations are so low they have to be a buy. But you want to know the problem with that is I could have said last year and the year before. So it does seem to me that at least there is something in the equity world that looks cheap, but it's certainly not the S&P 500.
And what we've seen so far since the US stock market starting to go down in response to this uncertainty leashed by Trump is that the cheaper markets like Germany and so forth have been doing relatively well. So it's a nice vindication for value. There always comes a point in a market cycle where people feel that value investing is dead, that value no longer matters, that market's driven by momentum and hopes for the future and very strong prospective earnings growth. And I think who knows, but we may be on the cusp. I'll give you one example, Johnson. I was at a value investment conference in Zurich last October. There was a Swiss value investor who named as his proposed stock a German semiconductor manufacturer. And there was a sort of gasp in the room. It would be equivalent to suggesting, say, a Japanese value stock 15 years ago or something like that. So it was gasp in the room. And then I spoke to a fellow afterwards. He said he thought that his portfolio was trading at roughly 50% of what his calculation of fair value was, whereas normally he thought it would be expected to trade at about 75% of fair value. So that gives you, if you will, a subjective view on the prospect value. Now, value can be double-edged. It can protect you when an overvalued market is coming down out of the US, On the other hand, value stocks are typically smaller companies, typically lower quality, and can therefore suffer worse impact on fundamentals if you were to go into a very severe economic downturn.
I can't let this opportunity pass without saying that if anybody wants to hear more from Edward Chancellor on the capital cycle and how to invest, they should attend the Practical History of Financial Markets course, because we have you teaching this now, and it may be a particularly good time to understand the capital cycle, which is not value per se, it's maybe a subset. And the validation you mentioned, maybe we're validating value in the first 3 months of this year. I'm sure there's many people listening to this who've held value funds saying that we'd like 10 years of validation.
I mean, I've had this idea, just an intuition, is that stuff that has worked well over the last month or so is probably going to have some legs. So I'm thinking, I am being a bit of a momentum thing, but I think gold is going to have legs under the current. And I actually,
we're going to come on to that.
I think,
nice question.
well, on the subject of, I mean, Russell's a gold bug, so am I. But most people run gold with almost no gold, or very little gold in their portfolios. The Indians run about 15% gold in their portfolios. And I can see in a world where you've got your financial repression, you've got bond yields rising, and you bear in mind that we're in year 3 of a potential multi-decade bear market in bonds, if the future is anything like the past. Well, you can see in that circumstance that actually it makes sense to have really quite a large allocation to gold. And I'm talking sort of in the range of 20 to 30%, in a world where if gold is the asset for uncertainty, and to go back to Roosevelt in the 1930s, although Roosevelt had banned gold, the Americans, needless to say, were all buying gold in London and storage in the vaults. So if we're moving into an era of uncertainty, unless you're going to use derivatives, you want a simple sort of uncertainty allocation in your portfolio, some risk allocation in equities, and perhaps some yield or whatever from bonds. But I can see the world moving towards much higher allocations of gold.
I think it's even better than that. So I think you've got a very accurate diagnosis of the disease and why it's good for gold. I think the cure is also good for gold. The cure is more government interference in the movement of capital, me internally and externally. And the more the government decides that they want to get into your pension fund and allocate it accordingly, the more people will shift towards gold, which, let's face it, can be held in other places. That's one of the long-term benefits that gold has had. So I think both disease and the cure point towards gold, despite the fact it has done exceptionally well, and it'll continue to be volatile.
There's a lot of momentum, and despite the fact that it upsets economists because it's meant to not behave this way when we're in the environment we're in.
Economists hate it because it's a sterile asset. I can see that, but economists have never been very good savers, so they don't really understand this, what gold is all about.
And economists, you don't want to give your money to manage, do you?
No. So final question then. A friend of mine, Simon Edelson, who's a fund manager, he's been writing an article in the FT saying that it's very tempting to put a hard hat on at the moment. You'd agree with that, obviously.
Yeah, I absolutely would agree with that. As you know, timing on these things is exceptionally difficult. See, a hard hat I'd say is cash deposits. In the long run, you should never really have that. And if my world is right toward financial repression and high inflation, you're certainly not going to do well out of cash. But it is worth pointing out that in that period from the late 60s to the early 70s, we had high inflation. And you lost money in deposit in real terms, but a hell of a lot less than you lost in bonds and equities. So the volatility is there. It's not going away. I think the uncertainty is not going away. So in terms of more cash than normal, then it will cash than normal.
I think so. And bearing in mind valuation of US stock market, which is a dominant position in the global equity market. So people who think they're not exposed to US because they're buying a world index are deluding themselves. When a market is very highly valued in bubble territory and runs into a period of uncertainty, possibly rising interest rates, then holding your cash, abnormally large amount of your portfolio, in dry powder makes sense, because you can use that dry powder at a later stage. Obviously, you don't want to be holding dry powder when the market is down 50% and the stocks are trading on Russell's 10 times cyclically adjusted earnings. But that's not the situation today.
And gold is a sterile asset, and you don't want to own a sterile asset over the long term. But if it keeps its value while the productive asset goes down, which is equity, that's what you're looking for. You want to get it into that equity at the right price. We're just saying it's currently the wrong price.
So the bottom line is people have got to relearn a bit of financial history, essentially, if they want to know what to do from here.
I've been saying that for 30 years. Finally, and I should one more slight plug, we are going to open Library Mistakes London. So if anybody's interested, they can contact us through librarymistakes.com. And the world is ready for more financial history, and we're getting lots of inquiries from all over the world. So I've got tangible evidence that the world is interested in more financial history, and that just, of course, too late.
So that will be one green shoot, at least, that we can take from the current situation. So I'd like to thank you both for taking part in this podcast. I've been talking to Russell Napier, the founder of the Library Mistakes in Edinburgh and a well-known distinguished global strategist, and financial historian Edward Chancellor, whose book on interest rates, I think, is required reading for anybody who wants to understand what has happened, how we got here, and potentially where we're going to go from here, which is not necessarily unalloyed good outcome.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.